to this edition of the Money Mile. Joining me today is Radhika Gupta, one of the most dynamic leaders of the Indian mutual fund industry. She is the CEO at Edelweiss Asset Management. Thanks, Radhika. Great talking to you after many, many years. Radhika, you've been a great believer in advisor zaruri hai. And, when it comes to debt, probably to understand the risks involved with it, it becomes even more important to have an advisor. Do you feel so? Equity is that way a little more simpler. But also, when an investor picks a debt scheme, and I'm talking from a risk and a return kind of a point of view, what are the factors that an investor should keep in mind? And as an advisor, very, very critical to have when you invest in debt?
So I think it's absolutely important to have an advisor for equity, for debt, and for your overall life planning. I think it's very important to have advice in any domain of life. I mean, whether it's sports or coaching or fitness or any domain in life. So I think the need for an advisor doesn't go away. I would encourage investors, one of the things that I've seen over the last few weeks and years is to ask tougher questions of their advisor and to push their advisor to ask tougher questions of the AMC. I think many of the conversations we have are, what was the last year return? Kitna milega? And I think those questions need to steer away from returns. I think in debt mutual funds, the basic things that you need to check are, what is the underlying portfolio? Now, this is very easy, right? You just get someone's portfolio, you take a look at the ratings, you also take a look at the names and anecdotally see, am I comfortable with it? Ask your advisor, okay, what in this portfolio worries you? The second thing to check in a portfolio is obviously liquidity. Many of the issues that we've seen are actually manifestations of not liquidity. So if you're investing in mutual funds, you're obviously expecting that if you put a redemption today, you will get your money back tomorrow or day after or whatever the redemption cycle is. So ask your investor, if this fund had 10% outflows, will it be able to manage? Is it liquid? I think these are the kind of questions investors should ask their advisors. I have a very simple framework, Vivek, for investing in debt mutual funds personally that I use because, unfortunately, there are 16 categories of debt mutual funds, and I really believe it's too much. When you go into a bank, you have a savings account where you park short-term money, and you have FDs of various tenures, and, life really ends here. We have 16 categories. I bucket my money into 3 parts, and this is what I do personally. Less than 3-month money I put into overnight and liquid funds. There's nothing wrong, absolutely safe, get your money back the next day, easy. Money between 3 months and 3 years, I typically put into a category called arbitrage funds. Again, very low credit or duration risk. I know what's going on in the fund, plus the advantage of 15% taxation. And above 3 years, I put into these Bharat bond or roll down or corporate bond funds that are of highest quality. And that's my framework for investing in debt funds. And I feel I don't need to do any more.
Always a pleasure talking to you. Thank you very much, Radhika, for joining me here and educating our viewers on these very, very important issues. Thank you.
Thank you, Vivek.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.